The financial markets have had unprecedented volatility and have been roiled by conditions, news, the COVID-19 virus. And in the face of all this tumultuousness, I have turned to Mr. Joe Turner to come join us today to talk about these financial markets. And Joe, who has just very recently retired, had a 50-year career in financial markets, has developed and produced a very impressive track record of performance for his clients. And now we are asking Joe to help us to navigate this incredible market volatility that we are currently experiencing. And with that, Joe Turner, he's sitting here right next to me. Thank you for being here.
Thanks, Bruce, for inviting me. But I notice it's, only when there's blood in the streets do you invite me as a guest. and we certainly have that going on today.
Well, thank you for being here and helping us to unravel the mysteries of this market. And we're calling this Search for a Cause because in Wyckoff terms, this is what we need to do. We've talked about this, but today's agenda, in no particular order, because it's all kind of jumbled together, is that we're going to do a stock market update with some trend analysis and a point and figure study, which is actually an intraday point and figure study. And we're going to talk about sentiment, and then we're going to get into sector and industry group ETF analysis. So with that, welcome to Power Charting. So the first thing, Joe, is we're looking at here this long-term yearly bar chart of the S&P 500 going back to 1924. In 1942, in the depths of World War II, began an uptrend, which we are drawing this trend channel. And this remarkable trend channel has really been in force on a logarithmic scale since that time. And what we had said, we asked the question, is the final bar a climax run at the end of a bull run? And this climax bar was the year 2019. And we said at the time that, now it's looking a little more prescient than it did at the end of the year when we put this chart up. But here we said, if there is going to be a continuation of the uptrend in 2020, that there was still likely going to be resistance that was going to take place because we are at the overbought line of this very long-term uptrend. And that appears to be the case here. And the volatility is really expanding in 2020. You can see that this bar is ever widening.
It's really difficult to lean into the wind and take away the punch bowl, so to speak, when everybody's having a great time, to sit there and put the question out there, is this the end? Because nobody wants to believe that.
Well, let's keep going. So this is a chart that is through Thursday, March 12th, as we're recording this. And you can see that this is a upward stride or a trend channel that was crafted starting back at the beginning of 2016. And there was a beautiful uptrend that was formed. We call this the demand line in Wyckoff. And the break in late 2018 took the market down below the demand line trend channel. And then the 2019 bull run basically took it right back up to the demand line. It threw over the top of it, became overbought. This is what we were saying on that yearly chart was the climactic run, so to speak. But Joe, look at the sheer volatility that has occurred in 4 weeks. We have almost completely taken back in the S&P the bull run of 2019 in 4 weeks.
Sure makes the case here for analysis or technical analysis that things move violently from place to place at times.
Wow.
And here's that chart we're looking at here certainly demonstrates that point.
Well, this decline in 2018 from September, October through Christmas Eve at the end of 2018 was a pretty stiff correction, and really was difficult to go through. And you can see that this almost appears to be currently a magnitude larger than the prior one.
So we're saying the fourth quarter of 2018 was just a warm up. And I remember 2018.
It was painful.
It was painful,
Yeah.
absolutely.
Yeah. So moving on. So you can see here, this is the basically a daily chart of the Dow Industrials. These charts, I've published them before. Again, this is through the morning of March 12th. And again, when we were at the upthrusting of this overbought channel, in January, there was a peak, and in February is a peak. And you can see that was right around mid-February was the final peak in the market. And it had just thrown over 29,509, which was the minimum count objective of this August point and figure area. And then also, so this is the accumulation area back at the end of 2018. They confirmed each other. So now we've thrown over that, and I want everybody to just remember that mid-February peak, which was at 29,568. And because we're going to come back to that in a minute. Joe, any thoughts as you're seeing this?
Just the thing that's just outstanding about this chart is look at the gaps here in the last 2 weeks. I mean, there's gap, and all of these are emotional reactions to the market and to the news and so on. But gap, 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 panic, gap. That's a remarkable chart, but it does show the nature that the stock market is a very emotional entity.
Now, the president made a speech last night, and actually closed down air travel from Europe. And you can see this massive gap that's occurred between yesterday and today, which has the feeling of a real climactic nature to it. Now, the warning here is, and we talk about this all the time, especially in downtrends, is the volatility is just immense. And the thing about gaps like this is that they're and declines of this volatility and magnitude is they're hard to stop. And so it's really what we want to do as Wycoffians is focus on the building of a cause. And we're going to talk a little more about that, but it's really only for the pros to be able to step in and try to trade buying and selling climaxes, and it's not recommended for most of us, and is not really where the big opportunities are either. So this is a real warning, and we don't make any recommendations here. This is all for educational purposes, and so just keep that in mind, is that we're not making trading recommendations. This is, I'm going to go ahead and put up all this, and I'm not sure if, Joe, you've seen this chart before. This is a 116-year U.S. presidential election cycle, and it's all the presidential election years. And we were using this as a model, or a template for how 2020 could go. But with the sheer magnitude of the decline that we've seen, I think that we have to rethink that this could be a reaccumulation structure, which again, we are looking for a cause to build because we had used up all the fuel in the tank into the end of 2019. And so we said the market needed to build a new cause. Well, and we also pointed out this buying climax, when you correct off of those, that they can be really volatile and scary. Little did I know, right?
Right.
It's like, what?
Be careful what you talk about or wish for.
Geez, my gosh. And so here, let's think about this. I still think that this has merit as a, let me do a highlighter here. I think this has merit, but the thing to keep in mind, let me change the color. So we were looking at a January peak in this model. And in fact, we did get a January peak, but then we got a mid-February peak. And so what we're thinking, or what I'm thinking, is that this reaction, which has been spectacularly large and very scary, in about 4 weeks, and that's exactly how long we have been really marking down here, is that it got pushed back a month, and that we're looking at a mid-February peak and a mid-March low. And so we're moving this out in time about a month. And so then the other thing that we need to see is we need to see even in a reaccumulation, we need to see a cause build. And so so we would look for a cause to be built in March that would lead to a rally. I don't believe that the rally that we're going to get can get to the prior highs, because it's just too much price damage.
Exactly. It's highly unlikely a new high given the amount of damage done. And just think about the whole process of the virus here. It's not like it's going to end tomorrow morning at 10 o'clock. It's going to drag out for a while. But given the magnitude of the decline off that top, we do have a rally out there. Probably does not go to a new high. And then we'll see further buildup of the cause or another decline.
Now, because we're looking at something different from a reaccumulation, which is what we had talked about in the past. And here, let me just show you that just one thing, and that is, we said the 2019 rally needed a rest. A new cause needs to form. And so before an uptrend could resume, or any kind of an uptrend could start. And so we are again looking for a cause. And in this case, we were considering the idea that it could take 6 months for a good cause to build for another upward trend. Well, you know, that idea is still very much a real possibility. But I think we're looking at an accumulation structure rather than looking at a reaccumulation structure. And so here, I just put this in because we're looking at, in an accumulation structure, a very sharp decline that goes down into a selling climax, and then you get some kind of an automatic rally. Well, we're still in the selling phase of this downtrend, and there's no telling where this is going to stop. But when we get the selling climax and the automatic rally, wherever that might happen, then we would look for a support area, a resistance area, and then we would be searching for one of two things. We would either be looking for some kind of an accumulation that could take months and months, potentially, or we could be looking at redistribution for another drop. And at this point, we can't really tell what we're going to get. And so, Joe, your thoughts?
Well, the other possibility, it could take months, but one of the fascinating aspects of point and figure is it covers the volatility. When we have volatility like this, and 500 point, 1,000 point hourly moves or daily moves, certainly, we can get a lot of column changes to go through this whole sequence.
Such a good point, because you can see here that in the early part of an accumulation, you have an immense volatility up and down. And that's right. What you're saying about that's what creates point figure count.
Exactly.
Yeah. Yeah. And then only when you get later into the structure does the volatility tend to come out, and the point and figure starts to become less dramatic.
Right.
Yeah, okay, good. Good, very good point. Thank you. Okay, so here we are looking at sentiment. Where the last two charts we're going to look at, and then we're going to get into sector analysis, this is that put call chart that we've shown in prior episodes. And you can see here that the put call has really, really spiked. And what we like to do is we like to do a 10-day moving average, because the 10-day moving average tends to smooth out the data. And it takes a certain amount of time to really build up enough cumulative speculative excess. The 10-day tends to pick that up. But the thing that really stands out to me, Joe, is look at how high the spike has now become in the red line, which is the daily data. It's now as extreme as it was back in December of 2019. The sentiment now is as intense, and the 10-day average is actually higher today than it was back in December of 2019. 2018.
December 18, right?
2018.
At that low, right? And then we just rallied right out of there. And this is a great indicator to measure the psychology or sentiment. And of course, we need the discipline, the emotional discipline, to move opposite of this particular fear measurement. And certainly looking at December of 18, you had tremendous pessimism. And then we worked that pessimism off during the year. And in fact, as we got to the end of 2019 and the first month or two of this year, we had just the opposite. There was very little put buying because everybody was so bullish. Why buy puts if you think the market's going to do nothing but go up, up, and up? And of course, that was a warning, a tremendous warning in itself. And now here we are. We've gone round trip. And in fact, this particular indicator, I think, is one of the CNN fear and greed components.
Mm-hmm.
Right.
Mm-hmm.
And I think that that chart, and I think you've got a picture.
I have it here. And I just want to again emphasize how extreme the call buying became in the end of 2019, and that it had reached levels that it hadn't seen all year in a very stout bullish uptrend. And that the amount of bullish speculation that came at the end of 2019 and into 2020 was just really very, very high. And these people that were speculating in such a way were punished by their extreme views. And now we're looking at the opposite, but we may have to spend more time up here, with this bearishness. So here is the CNN Fear and Greed Index. You can just go into a search and find this, and it's really a great tool to look at. And at the time that I had done this back a year ago, and this was introduced to me by Joe, is a year ago, back in December 2018, this index had gotten all the way down to three, I think.
Correct.
And Joe had made a presentation and shown that. Well, and that was back here, right there. And so now we can see that we have gone from a very extreme reading of, I believe it hit 97, if I remember correctly, here at the end of 2019, and has just been selling off ever since. And now it's at a very low reading. And Joe just looked it up. This was as of the 10th, I think. But anyway, the day before, the reading was 3, and it was 4 when I did this. But you just looked it up.
Yeah, markets are moving fast. The fear and greed index is now a lowly 1. Wow. So in other words, you can't get much more pessimism into the picture out here. Just to backtrack on this chart a little bit, one of the things that from our observation we say that the stock market is nothing but fear and greed superimposed on the business cycle. So obviously the economy hasn't tanked, 20% worse today than it was 2 weeks ago or 4 weeks ago. But the stock market is down 20%. And that's just going from this extreme of greed. And it was hard when you were making a call a few weeks ago about all the extremes you were seeing to lean against all the opinions that were out there, because that's what creates these emotional extremes. But if you look at this chart, you'll see that you could really use this to your advantage, in that there's going to be 2 or 3 opportunities a year to trim or fill out your portfolio that will really make a difference in your performance over time. So certainly it looks like we're entering a window of opportunity. There was an opportunity to do some selling, cleaning portfolios, selling extended positions or laggards back December, January. Certainly early in the year was a great opportunity to buy stocks when we had fear readings like we have today. So it's a great tool. Very hard to do, but Bruce, you and I have had a great friend, Hank Pruden, who taught for many years at Golden Gate University. And he often said, turn things upside down. And it's a great way just to think as you turn on the news and you hear all the commentators yelling and screaming and talking fast, that maybe there's opportunity, not panic, should be the byword. We know we're oversold. We know there's a lot of fear. Sentiment tends to be a little bit early. As Bruce pointed out, now it's time to start looking for that cause to be built. And I think that there's to look at a bottom and that last point down there, there's several things that we look to happen. And just some of the checklist items that you could look for now that we have this extreme in sentiment. You could look for a 90% up day. We've had 5, and probably with today, 6 90% down days. So sellers are in charge. But one of these days, they're going to exhaust themselves. We're going to have a 90% up day. And that's going to be a sign that we've run out of selling and buyers are stepping back in to take control. Other things, investment business daily has calculated something they call a follow-through day. I'm sure it'll be in the news. One of the things I think that you could look for as we are talking this Thursday morning, in the stock market, there are 0 new highs and over 2,000 new lows. Now, there's only 3,000 stocks traded a day on the New York Stock Exchange. 2/3 of those right now are making 52-week lows. Well, there's something called selling or buying climaxes out there. And I suspect that these 2,000 plus new lows today are somewhere in the next week or two, hopefully, are going to have a reversal. They're going to make a new low, and then they're going to close up for the week. That's the definition of a selling climax. So lots of raw material for a selling climax. That could be an event. So any number of those things can start the process of building a bottom. And then from that point on, it's all part of trend, price improvement. Let the market prove to you that the buyers are now in control. And of course, that could be
just building a cause.
Building a cause.
Yeah, using a Wyckoff-ian term.
Exactly.
And so here, let's just take a few minutes and look at some sectors. And so you can see, as we are looking here at these candle glances, these are weekly bars and relative strength to the S&P 500. And you can see that in every case, these sectors are below their long-term moving averages. And some are much worse than others. What I like to do is I like to look at the relative strength. And so you can see here that technology, for instance, has an upward striding relative strength line. and it's just recently broken its rising 39-week moving average. And so that's very constructive. But look at industrials next to it. Notice how they have broken down, but they had been below their relative strength was below its long-term moving average and was in a downtrend, and now the relative strength is starting to accelerate lower. So just in a candle glance, these are attributes that I like to look for, Joe.
You know, one of the ones that is intriguing, at the bottom of your schematic here, you've got real estate and financial.
Mm-hmm.
And real estate is showing some relative strength out there, even during its decline, which that's intriguing. But especially when you compare it to the financial group, including the banks and so on, that is totally collapsed in terms of relative strength. But I know that the banks are in phenomenally good financial condition. And for example, the Fed every year runs a stress test. How is your bank going to hold up within a bad environment? So every year they throw in a situation out there and they ask the banks, how are you going to do? And in this case, this year, I think the stress was, okay, a stock market decline of 50%, commercial real estate drops 35%, unemployment goes up to 10.5%. Will you still survive? And all banks that the Fed tested passed with flying colors. So the banks are incredibly great shape. Their capital structure is they could survive almost anything. So again, it's too early, but let's see if that starts building some resistance to the decline.
Well, banks are almost back to their 2016 lows.
That's incredible, right?
And you can see the relative strength has been in a downtrend now since mid-2018. And so we could be in the realm of an important low. And of course, banks have dividends.
Oh, the fundamentals, you could just go all through the group and find single-digit price earnings ratios and very attractive dividend yields in this world of no or low yields.
So here's the regionals, and you can see the relative strength. So this would be, again, you'd want to look for some kind of an accumulation structure. Oops. So you can see back here in 2016, there was a beautiful accumulation structure before an uptrend. And we would want to see something like that again. And so we will, we're running out of time here. Any final thoughts for us, Joe? We so appreciate your time with us.
No, I think just turn this market upside down, look at the opportunity, keep your seatbelt fastened, but there's going to be a low in here. There's going to be the conditions that mark a bottom, do the accumulation. So look at this as opportunity.
By the way, Joe is one of the early members of the TSAA, and it really is how I got to know Joe initially, was through the TSAA, and a great organization, not-for-profit, education-oriented, great guests, doing a number of webinars and so on. So go check them out. And this is the 50th year for the TSAA. And on that, Joe, thank you so much for being here.
Thanks, Bruce. And good charting, everybody.